Welcome to The Deep Dive, your personalized exploration of critical market insights. Today, we're taking a closer look at Harley-Davidson's second quarter 2025 investor call from back on July 30th.
Yeah, and this one was really interesting. It presented this, well, pretty complex picture, didn't it?
It really did. But somehow, it led to, a very significant positive market reaction. So our mission today is to unpack exactly why the market got so enthusiastic about what looked, frankly, like a bit of a mixed bag.
That's the fascinating part, how the market interpreted it all. It immediately tells you investors were looking, beyond just the quarterly numbers. They clearly prioritized a big strategic shift, something that kind of reframed the whole long-term story for the company.
Right. Like you said, it's like someone suddenly paying off a huge mortgage, instant de-risking, frees up cash. The market saw that value unlock immediately.
Exactly.
Okay, so let's dive into that mixed picture first. Just a snapshot of the Q2 2025 results. Harley-Davidson delivered some definitely contrasting figures. GAAP EPS that came in at $0.88.
Which actually missed the consensus, right? Analysts were expecting around 96.
Correct. A miss on EPS.
Yeah.
But consolidated revenue was $1.307 billion.
And that smashed expectations. Analysts were looking for about $1.1 billion, so an 18% beat there.
A really solid beat on revenue. Although, still important to note, that revenue number itself was down 19% compared to last year.
So right away, you see that contrast. EPS miss, big revenue beat, but overall revenue declining year over year.
It definitely tells you the story isn't simple, yeah. Sets the stage for digging deeper into what the market actually liked.
Precisely.
And what they found was really a tale of two segments, plus, Livewire in the mix too. If we break down the core business, HDNC Harley-Davidson Motor Company, the bikes, they definitely face some headwinds.
Yeah, that part wasn't pretty.
Revenue dropped 23% year over year for HDMC. Gross margin was 28.6%. That's down 3.5 percentage points.
Ouch. Margin compression there.
And operating margin was even softer, 5.9%. That's down a big 8.8 percentage points. Wow. Plus, motorcycle shipments fell 28% to about 35,800 units. And global retail sales, down 15%.
Okay, so with that kind of softness in the main motorcycle business, the immediate question for any investor is, what on earth drove that positive market reaction? This wasn't just a small dip, it was a pretty significant hit to their core segment.
That is the million-dollar question, isn't it? What could possibly outweigh all that? And the answer seems to lie with the other major segment, HDFS, Harley-Davidson Financial Services, their lending arm.
The finance side. Often overlooked, but clearly critical here.
Totally. HDFS was a completely different story. Revenue was down only a modest 2%, came in at $257 million. But crucially, it maintained a really strong operating margin of 27.1%.
Very healthy margin.
And then there's Livewire, the electric brand. Reported an operating loss of $19 million.
Which sounds bad, but it was actually better than last year.
Exactly. An improvement from a $28 million loss in Q2 2024. Although unit sales were pretty low, down to 55 from 158.
Still finding its feet, it seems.
Yeah. So overall, despite the HDMC struggles, the market's response, especially to the strategic news around HDFS, was just overwhelmingly positive. It really signals investors prioritizing long-term value, that strategic pivot, over the immediate softness in bike sales.
It's that forward-looking perspective, isn't it? Investors saw past the immediate operational bumps and focused on a path to a stronger financial footing and a, cleaner company structure.
Okay, so with that market reaction clear, let's peel back the layers. Let's get into the key financials and what management actually said. It really is this dual narrative, acknowledging the headwinds for bikes, but also unveiling this huge transformative strategy for HDFS.
And that dual narrative is important. It shows they're not ignoring the problems, but they're also making bold moves elsewhere. Speaks volumes about their long-term thinking.
Let's start with that transformative move, because honestly, that's where all the excitement was.
Definitely the main event.
The biggest news, the real headline grabber, was the strategic partnership for HDFS with KKR and PIMCO. It involves selling a 4.9% common equity stake in HDFS to each of them.
And that 4.9% figure was deliberate, wasn't it?
Yes, the CFO, Jonathan Root, specifically mentioned it was chosen for regulatory ease, basically to avoid triggering more complex FDIC rules.
Smart. Streamlining the process shows they wanted this done efficiently.
Management was very clear. They said this deal clearly reinforces our view of HDFS's strategic and financial value. And the investment values HDFS at about 1.75 times its post-transaction book value. Pretty strong validation.
A good multiple.
And here's the big shift. HDFS is moving to a capital light model.
Okay, what does that mean exactly?
Essentially, they're offloading most of the risk and the capital tied up in their loan book. It frees up cash, reduces their balance sheet exposure. They're doing it by selling over $5 billion worth of existing retail loans and residual interests.
Wow, $5 billion, that's a huge chunk.
It is. And going forward, KKR and PIMCO will buy about 2/3 of HDFS's future loan originations each year for 5 years. And they'll pay a premium for those loans while HDFS keeps the remaining 1/3.
Okay, so HDFS still originates, still provides the service, but holds much less of the actual loan assets and risk on its own books.
Exactly. And this model is expected to seriously boost HDFS's return on equity. They're talking high 20s.
That's a significant jump in ROE. And freeing up equity for the parent company, Harley-Davidson itself, that's key.
Absolutely massive implications for financial flexibility. The transaction is expected to unlock roughly $1.25 billion in cash for Harley-Davidson.
$1.25 billion. That's serious cash. What are they planning to do with it?
They laid it out pretty clearly. About $450 million is earmarked for reducing debt.
Good move. Strengthens the balance sheet.
Around $500 million for accelerated share buybacks in the second half of this year, 2025. That's part of their existing $1 billion program.
Returning capital to shareholders. Investors always like to see that.
And then up to $300 million set aside for future growth investments.
So debt paydown, buybacks, and growth fuel. A pretty balanced approach. It signals confidence.
Definitely. They also project the deal will boost HDFS operating income by $275 to $300 million just in this fiscal year 2025.
Just from the mechanics of the deal itself.
Right. And longer term, they see HDFS getting back to its pre-transaction operating income levels around $240, $250 million a year, but doing it in that much more efficient asset-light way.
So similar profit potential, but with far less capital tied up. That's the beauty of the capital light model.
And the CEO, Jochen Seitz, made a really pointed comment. He highlighted that the total HDFS value implied by this deal, the $1.25 billion cash distribution, plus the value of the remaining equity, comes out to around $1.75 billion.
Okay.
And he compared that $1.75 billion directly to Harley's entire market cap at the time, which was roughly $3 billion.
I see. So the implication is...
The implication, as he put it, is a substantial undervaluation of HDMC relative to other comparable companies. Basically saying, look how valuable HDFS is. The market isn't giving nearly enough credit to our core motorcycle business.
That's a very direct message to the market, basically arguing that the sum of the parts is worth much more than the current share price reflects, and this deal helps crystallize that value. But for you, the listener, the key question is still there. Does this financial maneuvering fix the demand problem for the actual motorcycles, or does it just buy time?
That is the crucial question. And it brings us right back to the other side of that dual narrative, the challenges facing HDMC.
Yeah.
Because it's clear, it's not all sunshine and roses there. Consolidated revenue was down 19%, which they blamed on a planned reduction in motorcycle shipments and soft demand.
Soft demand. That's the core issue.
Global retail sales down 15%. And they pointed fingers at elevated interest rates, broader demand softness, and just overall economic uncertainty. Familiar headwinds for discretionary goods.
Okay, so they acknowledge the problem. But acknowledging isn't enough. What are they doing about it? What are the strategic responses for HDMC?
Right, they have to respond. They announced a new efficiency program, leveraging tech, including AI, aiming for substantial cost savings and further productivity gains.
Trying to streamline operations, protect margins in a tougher environment. Makes sense.
They're also continuing to right-size inventory. Global dealer inventory is down 28% year over year. That's the third quarter in a row it's decreased.
That's important. Getting inventory levels right is critical when demand is shaky, prevents heavy discounting, protects the brand.
Yeah, they want levels very healthy by year end. Tariffs are still a factor, cost them $13 million in Q2. It's actually why they withheld full year guidance for HDMC, citing that tariff uncertainty.
Still an overhang then.
But some good news there too. They revised their estimate for the full year direct tariff impact way down. From $130 to $175 million previously, down to between $50 million and $85 million now.
Okay, that's a significant reduction. Even with uncertainty, a lower cost burden is definitely a positive for the core business.
Definitely helps the bottom line. And one more potential positive tailwind. Harley bikes got included in some recent U.S. tax legislation.
Oh, what's that about?
It allows interest paid on loans for new U.S.-built motorcycle purchases up to $10,000 a year to be tax deductible.
Ah, okay. So it effectively lowers the borrowing costs for consumers.
Exactly. They expect it to help stimulate demand, especially with interest rates being higher.
That could certainly help on the affordability front. A nice little government-backed incentive.
Okay, let's shift gears slightly to product and growth stuff. What's coming down the pipeline? Management confirmed they're launching a smaller entry-level model called the Sprint.
The Sprint. Haven't heard that name in a while from Harley.
Right. It's aimed at the U.S. and international markets, coming in the first half of 2026, targeting a price point below $6,000.
Below $6,000. That's definitely aiming for accessibility. Is it expected to be profitable?
They specifically said yes, expected to be profitable. They're showing it to dealers this October. And they mentioned another profitable, iconic entry price point bike in the traditional cruiser style is planned to follow the Sprint.
Okay, so a clear push into more accessible, lower price segments. That seems like a smart move to broaden the customer base, attract younger or newer riders, maybe.
Seems to be the strategy. They're also leaning into their racing heritage. The CVO Road Glide RR race replica apparently sold out immediately.
People love those limited editions.
Yeah. And they've got a new MotoGP partnership to launch a bagger racing series in 2026, trying to build excitement around the brand.
Racing connects with the core enthusiasts for sure.
Yeah.
What about Livewire? Any updates there beyond the smaller loss?
They narrowed the full-year operating loss guidance for Livewire to between $59 and $69 million. They stressed a commitment to significantly reducing cash burn and operating losses.
So getting more discipline with the EV spending.
Seems like it. And they're launching production versions of 2 new mini motors concepts in November, focused on lightweight off-road and urban-friendly mobility solutions.
Mini motors. Interesting pivot. Maybe smaller, more focused EV niches instead of trying to compete head-on with, full-size electric bikes initially.
Could be. Feels more pragmatic, maybe a faster path to profitability in specific segments. It lines up with that whole capital discipline theme we've been talking about.
Yeah, disciplined investment, not just innovation for innovation's sake.
Yeah.
Makes sense in this climate.
And one last point. Leadership. A new CEO, Artie Starrs, is taking over on October 1st. They made sure to say he's fully aligned with all these strategic moves.
Important signal during a big transition. You want the market to know the new leader is fully bought into the plan, especially a plan this transformative.
Okay, so pulling it all together, what does this actually mean for you, the investor? Well, that immediate market rally tells the story. Investors are clearly prioritizing the HDFS deal, the balance sheet flexibility, the cash unlocked over the near-term softness in motorcycle sales.
Absolutely. The strategic move to de-risk HDFS and free up capital for debt reduction, buybacks, and growth, that's what drove the positive reaction. It effectively reframes the whole equity story, near term anyway. Provides clear catalysts like capital returns and a cleaner balance sheet.
The market basically looked past the EPS miss, looked past the weak retail sales, and focused on that long-term value unlock. They bought into the potential for a more focused, more capital-efficient Harley-Davidson.
It's a big vote of confidence in the strategy, not just the immediate performance numbers.
So key things to watch going forward. The actual closings of those HDFS asset sales, the first one happened August 25th.
Execution is key now.
Exactly. Execution of that $500 million buyback in the second half of the year. Any developments on tariffs or that tax deduction actually boosting sales.
And how well they manage that dealer inventory sell-through.
Critically. And then longer term, the big test will be the success of that lower price Sprint model under the new CEO. Can they actually reignite demand and bring in new customers?
That's the multi-billion-dollar question for the core business.
Interestingly, just looking at the stock performance, Harley actually outperformed the S&P 500 in the month after the call.
Reflecting that positive reaction.
But it still lagged the SPY over the past year.
Which highlights the challenges they were facing. This new strategy is clearly aimed at reversing that longer-term trend. The market's basically saying, okay, we see the plan, now show us you can execute.
Right. Okay, now for the part where we brainstorm some, shall we say, creative market plays based on all this. This is absolutely not financial advice, just some thought starters, purely educational.
Stretching the strategic muscles, perhaps. Thinking about how you might position yourself based on this narrative shift.
Okay, idea 1. Given the market's excitement about HDFS and that implied substantial undervaluation of the core HDMC business, consider a long-term paired trade. Go short a comparable, maybe high-leverage, discretionary consumer vehicle maker, and go long Harley-Davidson.
Okay, what's the thinking there?
The thesis is, Harley has de-risked its finance arm, freed up capital, and potentially set the stage for a re-rating of its core business value. The short position hedges against general weakness in consumer discretionary spending cars, boats, other bikes, whatever. While the long Harley position captures that specific re-rating potential if they execute on the buybacks, debt reduction, and the new product roadmap like the Sprint.
So isolating Harley's specific turnaround potential while hedging out broader market or sector risk. Interesting. The market's initial pop suggests the re-rating might already be starting, but maybe there's more room to run as the cash gets deployed.
Could be. Risk is obviously if the core HDMC demand just never recovers, but maybe the capital return provides some floor.
Okay, what's another idea?
All right, alternative thought.
Yeah.
A long-dated call option strategy on Harley, paired with a short position in a high-growth, high-burn EV motorcycle startup. One that maybe lacks a clear path to profit or doesn't have its own big financing arm.
Betting on the established player with a newly fortified balance sheet versus the potentially overhyped cash-burning disruptor.
Sort of. The HDFS deal gives Harley this war chest and a de-risked engine. Livewire seems to be getting more disciplined, focusing on those mini motors. Meanwhile, a lot of pure-play EV startups are still bleeding cash, needing funding in a tough rate environment.
So the trade bets that Harley's combination of financial strength, a renewed focus on profitable new products like Sprint, and a more pragmatic EV approach might win out over cash-hungry innovation in the current climate.
Exactly. The long calls capture Harley's upside if the strategy works. The short bets against potentially less sustainable EV business models. It's a bet on smart capital allocation and a profitable product pipeline over just pure disruption.
Two interesting angles on how to play the Harley turnaround story. Definitely not for the faint of heart, but plausible logic behind them.
For sure. Okay, let's recap the main points from the call. Harley's Q2 earnings deliver this powerful 1-2 punch. First, acknowledging the real challenges in the core motorcycle business, soft demand, tariff issues.
But then, crucially, unveiling that game-changing capital-light strategy for HDFS.
That pivot, unlocking $1.25 billion for debt paydown, buybacks, growth, that's what clearly fired up investors and drove the share price rally.
Absolutely. So the focus shifts entirely to execution now. Can they reignite demand with these new, cheaper models like the Sprint? Can they manage the remaining tariff impact? And critically, can they deliver on those capital return promises?
It really is a fascinating repositioning, isn't it? Trying to shift the story from, maybe a struggling legacy icon to a company strategically using its assets to build for the future and reward shareholders.
It is. The next few quarters are going to be absolutely critical in showing whether they can actually pull off this ambitious plan and redefine themselves.
So the blueprint is there. De-risk the finances, invest smartly, innovate pragmatically. But for you, the listener, the big question might just be, can a company so steeped in tradition truly reinvent itself? Or is this brilliant financial engineering just buying time while the core business tries to find its footing in a changing world? Something to think about. Thank you for tuning in to The Deep Dive. Remember, this information is purely for educational purposes and should definitely not be taken as financial advice.
Always do your own research, your own due diligence, and consider talking to a financial professional before making any investment decisions.